So I will talk about the table of contents today. What will we talk about today? We will start with liquidity and cash management. First of all, I should say that it's a hybrid training, actually. Some part of the training, as he also said, will be about cash management and cash flow forecasting, and some part of it will be about equity finance alternatives and business valuation. But it's not a business valuation training by itself, because we don't have such a time for analysis of each method of business valuation, but you will have an idea. We will talk about the basic concepts of business valuation, and we will talk also about some technology firms, what did they do in their equity funding states. And also we will provide some examples from deep tech companies and technology companies about liquidity and cash management. And we will take some notes, sector-specific notes about that too. So we will start with liquidity and cash management. And actually, cash management is one of the disciplines of liquidity management. And we will also talk about the other disciplines of it, net working capital and cash flow projection, and the main terms about them, and the term liquidity level of assets. How do we measure the liquidity level of an asset? We will talk about it. We will see some cash flow statements, and we will understand more about the types of cash flow statements. How do we use cash flows? I mean, when analysts say cash flow, which cash flow do they mean, and where do we use cash flows? There are some main uses of cash flows, like net present value calculation, internal rate of return calculation, and cash flow statements. We will talk about this. And some basic terms are very much confused. So we will talk about comparison of net income, net change in cash, and operating cash flow. And we will talk about the horizon frequency of some cash flow projection reports, the main data inputs of cash flow projection, and the main methods with some examples. We will go over a model while doing this. And we will also talk about the term free cash flow, because all those terms are about cash flow, but they are actually demonstrating different performance abilities of the firm. And we are going to go over net working capital and liquidity ratios. And in the second part of this webinar, we are going to go over the equity finance alternatives. First of all, we are going to understand debt finance and equity finance, the difference between them, how much debt finance and how much equity finance can be used, what are the optimum amounts, how do we decide on this, and rounds in equity funding, an example again, and some basic appraisal concepts, some real-life examples about risks of business valuation, and a variety of approaches to business combination and the main techniques. We'll just go over the main techniques, but without example, it's not enough, of course. We'll just understand the main concept of it and the terms about them. So let's start with liquidity and cash management. First of all, liquidity management should be defined. Liquidity management is the strategy and policy to optimize the availability of companies' assets to meet the financial obligations. And there are three main disciplines of it: cash management, cash flow projection, and net working capital management. And those three disciplines have interaction with each other. For example, the interaction of cash management and cash flow projection as a consequence of net change in cash, because both work in cash flow statement, and the bottom line of cash flow statement is net change in cash. And the cash flow projection and net working capital come together. Those two concepts come together to bring out the free cash flow, which is mostly used in business valuation and project finance. And the disciplines of cash management and net working capital concept is coming together in evaluation of the financial performance of the company through some liquidity and efficiency ratios. And the term liquidity is important here. Liquidity is the ability and ease of an asset or security to be converted into cash when needed without losing its market value. Of course, all assets we have can be converted into cash one day, but generally we have limited time when we have some funding requirements. So the time to sales of an asset is one of the measures of its liquidity level. And another measure for its liquidity is the availability of the fair price on which the buyer and seller agrees to make the transaction. So if we can find the fair price at an early time, as fast as possible, then that asset is having a high liquidity level. If we go over an example, let's say that we urgently need $1 million for our company within 1 week. And let's say that one of our bank loans has been called back, and the overdue interest is 1% per week, which is quite a bad situation. And our company in that situation, let's say, has only two types of assets, which are asset A and asset B. If we check that those two types of assets are both fixed assets, which means they are not one of the current assets of the company which take place on the upper side of the balance sheet, but they are just like property and plant, buildings, land. They are fixed assets, and their fair price should be $1 million. But since they are fixed assets, they can't be sold easily. For example, asset A, which consists of 50% of our total assets, can be sold within 1 month, but we need that money in 1 week. And asset B can be sold in 1 week, but not from its fair price, half of its fair price, from $500,000. Actually, if we check that balance sheet, we see that we have a serious problem here. We have enough assets to cover our debt, but our assets are all fixed, which means that we don't have any current assets which can be sold earlier. And that's why we are having loss on sale, either loss on sale or paying interest rates because of the interest expense, because of the overdue, 3 weeks overdue of selling that asset. Also, having only fixed assets in our balance sheet makes a concentration risk because of that, because if we have a short-term liability, we may not be able to cover this liability with our assets. So in that case, if our balance sheet is concentrated all with fixed assets, then we see that we cannot run away from having loss. Either we will pay interest expense or we will make loss on sale of our asset. And of course, in that case, we would choose to sell asset A because the loss that we will make, which will also be seen in income statement, would be less than the loss that we would make for asset B. Let's see another example in which we have excess of liquid assets. In the previous example, we were having two fixed assets, and in this example, we are having two current assets. And one of those current assets is cash and cash equivalents, and the other one is tradable securities. So this company doesn't have any accounts receivable, doesn't have any inventory, but only has cash and cash equivalents and tradable securities. And if it's not a finance institution, actually having this much tradable securities means market risk for that company, and it means it's not using its assets for its operation. It is generally working out of scope. And having this much cash and cash equivalents means cash surplus, which also means losing the opportunity, losing chance to catch some opportunities, making some discounts, etc. But for some deep tech firms, having high cash and cash equivalents has a different meaning. We will go over that in later sessions of the training. And we see that, again, there's a concentration risk that all of the assets are current assets in that case. So the company doesn't have any long-term investment. So it shows that the company doesn't have any future plans, which is very bad for the long-term borrowing of the company. Banks never like it, and banks never provide long-term loans to such firms, because you can't see any long-term assets, you can't see any investment, you can't see any strategy for this firm. And of course, since they are the most liquid assets, they can be sold easily and within one day. So there isn't any overdue interest, and also they can be sold from their fair value since they are tradable securities or cash. Cash and cash equivalents also no need to be sold. So the firm is for sure able to meet its short-term liabilities. There's no problem in that. So in excess of liquid assets, the obligations, short-term obligations can be met, but there is still a risk for those companies of missing opportunities and losing opportunities to move against competition because some rivals of this firm may be making some investments, and while they are keeping that much cash and tradable securities, they might be losing that chance. But in that case, we see that liquid assets are good for short-term liabilities, but having too much liquid assets is still not good for the firm. So if we start with the relationship between cash management and cash flow projection and their outcome net change in cash, we should start by defining the term cash management. What's this difference with liquidity management? People generally use them in the same meaning, but actually cash management is a discipline of liquidity management, and it is the optimization of the receipts and disbursements of the company in order to minimize the financial expenditures and improve the availability of assets to meet the financial obligations. So the targets, the aim is common in liquidity management and cash management and the other two disciplines. But cash management specifically works on the receipts and disbursements, the optimization of the receipts and disbursements and the bank relations. So the shortest term is the focus of cash management, not going to any cash deficits or any cash surplus within 1 week, within 2 weeks. That's the main subject of cash management, actually. And what is cash flow projection? Cash flow projection is basically the modeling of the cash flow statement. It is the modeling of the potential future cash streams, and it is what is trying to catch is the potential cash deficits and cash surpluses in the future. Because as we said, both cash deficits and cash surpluses, they are both risk for the firm. And they are both not good. Again, too much cash surplus is not perceived as a good sign by the banks. It shows that the firm is not making any long-term investment, and cash deficits are also bad for the sustainability and solvency of the firm. So the main idea in cash flow projection is to see that when if the firm has a potential to make any cash deficit and cash surpluses. So if the firm will have any cash deficit and cash surpluses, then the optimization of the surplus of cash, the related investments can be made, or related funding activities can be made earlier, and the firm won't leave any liquidity risk. So cash flow statement is, we said that the main output of both cash management and cash flow projection on which they work. And it is a financial, one of the three main financial statements, actually. As you know, financial statements are written reports that quantify the financial strength, performance, and liquidity of the company. And there are three main financial statements that we see. Legally, two are reported, but also within those two cash flows, the indirect cash flow statement can be made. And the first one is balance sheet, which is shown in every listed company within some periods. Income statement and cash flow statement, the indirect type of cash flow statement. Balance sheet is the snapshot of the financials of the firm at a particular moment, which shows what the firm owns and what it owes, and what is left over for the owners of the company. And income statement demonstrates the revenues and expenses along with the resulting net income or loss over a period of time is shown. So the bottom line of income statement is net income, what it's trying to reach. And cash flow statement reports the cash generated and spent during a specific period of time. But at that point, we should clarify the difference between these three financial statements, because some terms are very much confused because of this. For example, the cash flow items are being compared with net income, and sometimes people ask why net income is not being used instead of a free cash flow calculation in the place of a cash flow. The main difference between cash flow statement and the other main financial statements is about its accounting system. The balance sheet and income statements are based on accrual accounting, which is an accounting method where revenue or expenses are recorded when a transaction occurs, but not when the payment is received or made. So this accrual accounting method follows the matching principle, which says the revenues and expenses should be recognized in the same period. And when they are recognized when they are incurred, not the payment is made or cash is received. And accrual accounting involves tracking income and expenses as they are incurred, and it means that when an invoice is sent or bill is received. But the cash flow statement is based on cash accounting, which lets businesses record income and expenses only when cash is actually received or paid. So let's give an example to that. Let's say that for that training, I gave the bill to the list, and once I gave the bill, it is reflected to my income statement, right? Because it is a revenue according to my income statement, my company's income statement, because I have sent the bill and I made the training. But according to my cash flow statement, nothing happened until I received the money. So let's say that after a while, after a period, I received the money, then it is being recorded to my cash flow statement as a cash inflow. So the difference of revenue and cash inflow is mainly this. So when I bill the training to the, when I send the bill of the training to list, it is a revenue for my income statement, a revenue of 1 million euro, let's say, because you're worth it, I believe. And when I receive the money after 1 week, let's say it's a cash inflow. So nothing happens when I bill, but my cash flow records it as a cash inflow when I receive the 1 million. Okay, it's not 1 million euro, I confess, but it's something around. And we should also talk about the cash flow, the term cash flow, because cash flow statement is built up from cash flow, and cash flow, if cash flow is positive, it's cash flow, cash inflow, and if it's negative, it's cash outflow, the money that we paid and the money that we received. And the change in balance of the firm is shown within cash flow statements. And it is categorized in 3 parts: the change in balance from operational activities, the change in balance from investment activities, and financial activities. Here we see an example of a firm, Recursion. Maybe you've ever heard it. It's been established in 2013 and based in United States, a clinical stage biotechnology company industrializing drug discovery and decoding biology. And here we see its cash flow statement. As you see, net income is the first item of that cash flow statement. But net income doesn't refer to cash inflow. Therefore, the non-cash items are eliminated, added back, like depreciation to the cash flow statement, and then like the net income adjustments and depreciation, some other non-cash items, and then the change in working capital that we will talk about soon is being reflected in terms of cash inflow and cash outflow. For example, the accounts receivable, when the accounts receivable increase, it's a cash outflow. And when the accounts receivable decrease, it's a cash inflow from the perspective of cash flow statement recording. And we see that it is actually not making any cash from operating activities. But in investing activities, for example, there is a cash inflow, a big cash inflow. Therefore, its net cash flow or net change in balance, which is the bottom line of the cash flow statement, is positive actually. In year 2022, last year end, actually it didn't make any net income, it made loss. But its net change in cash, or in other words, net cash flow, the bottom line of cash flow statement, is positive. Let's check that what happens and it made such a cash inflow from investments. Maybe it has sold some fixed assets, or maybe it has earned from some other investments that amount. And most importantly, also in the financing activities, we see sale and purchase of stock. And we see that on October last year, it has made a private placement by offering common stocks to a pool of investors. So it sold its stocks, and that's why it has a cash inflow from there. And probably it sold one of its fixed assets, and therefore it has a cash inflow from investments. And that's how it made a positive net cash flow, net change in cash. Otherwise, probably it wouldn't be able to make such a change. And also, we should talk about some other uses of cash flow. We will again analyze the term net change in cash later in this training, but also operating cash flow is being used very frequently in financial analysis. And there are 2 other terms which is being used in project finance and business valuation and in many other points. I mean, they are not direct item of business valuation, but while funding activities are going on for business valuation, for sure they are being used for performance evaluation. One of those terms is net present value, and the other one is internal rate of return. They are related to each other, and they are actually showing the performance of a project or enterprise, and also free cash flow, which is being used for the valuation, business valuation purposes and project finance purposes, is another item which is used in cash flow analysis. If we go over the net present value, what do we mean with that? I think you all have an idea about time value of money. The money that we have today is more valuable than the money that we have in future. And the term net present value is mainly built on that. So let's say that we have a project and we made an investment of $10,000 for this project. And this project will make some cash inflows, net cash inflows to us within 4 years. In the first year, let's say, it will make a cash inflow. At the end of the year, it will make a $3,000 cash inflow. By the end of second year, $4,000, $6,000, and $8,000. And then we want to see how much this project is worth. So in 4 years, how much money will I make from this project? And we need to discount those future amounts to today. So we need to take the present value of those future cash inflows in order to calculate the net present value of those future cash inflows. And we see that we have invested $10,000 to that project, but in 4 years, we will only be receiving back $6,003 in that case. So why we are discounting it with 10%? Because 10% is chosen as term deposit rate here. So if we are earning 10% from term deposit rate, then we should discount those future cash flows with 10% because we are not investing our money to term deposit, and we are investing our money to that project. So we should earn at least as much as term deposit. That's what we expect to see from that rate, from that project, right? And what we should earn in 4 years in order not to be in loss. Here, it seems that we are in loss in such a case. That here we see that we don't have enough cash inflow to cover our initial investment. So internal rate of return is the return that projects should bring for that to cover that initial investment. So this project brings higher return than investing in term deposits, unless the deposit rates rise up to 31%. So it is the rate of return that you should receive in order to have this investment feasible. So these two terms are being used for the evaluation of some future cash inflows, but mainly in the business valuation, the discounted cash flow analysis and multiplier analysis and cost approach are being used. The main three techniques are being used in the valuation. But when we talk about a little project or part of an activity, then we generally use this net present value and IRR calculations. But in cash flow, we said they are mainly used in cash flow statements, and cash flow statements have two types: indirect cash flow statements and direct cash flow statements. For example, this cash flow statement of Recursion that we saw previously is an example of indirect cash flow statement. And its bottom line is the net change in cash. It is actually the bottom line of both direct and indirect cash flow statement, and it is the net amount of cash and cash equivalents created within a certain period. So at the end of the year, we see that Recursion could make this amount of net cash flow, $263 million of net cash flow from its activities, which also means that its bank balances increased that much. And the calculation of net change in cash can be made in two types: the adjustment of net income, which is used in the indirect cash flow statement, or direct data input, which is used in the direct cash flow statement. I said that it reflects the change in bank balances, but the best reflection of change in bank balances is shown in the direct cash flow statement, since it is the most recent data is being used there, and it is also made by using direct data input. Let's compare these two types of statements. One of them is indirect cash flow statement, which starts from net income. We said, but since net income doesn't refer to any cash inflow or cash outflow, the non-cash expenses and revenues are eliminated from net income. For example, the depreciation is being added back since it's not cash, and some other non-cash expenses like stock compensation, etc., is also like impairment charges, unrealized gain or loss, deferred income tax are being added or added back. And then the change in working capital is being reflected. We are going to talk about it soon. And we come to the operating cash flow, the money that we made from our operations. And then the money we made from investing activities like the capital expenditures or sales of an fixed asset is being shown in investing cash flows. And the financing activities like net borrowings or the paybacks, loan paybacks, and repayment of loans and sale or purchase of stocks are being shown in the financing part of the indirect cash flow statement. And as you see, the sum of these three, the operating cash flow, financing cash flow, and investing cash flow, gives us the net change in cash for the company. But in direct cash flow statements, we use direct data input, and of course this is a hypothetical table that I prepared because direct cash flow statements are confidential reports of firms. They don't report it, even if they are listed, they don't share their direct cash flow models. But if we show, for example, and their periods are from day to month, but they can't have a longer horizon than months because they are made in more difficult situations. All the related data is collected from related departments, and that's why it's the most accurate and most recent data being used in direct cash flow statements. And what does it show? It shows the cash inflows and cash outflows of the company in near future. Since it's a deep tech company, making a daily based direct cash flow wouldn't be logical. And even weekly based direct cash flow may not be logical for a deep tech firm because its revenues is not received that frequently. Probably minimum monthly recurring revenues can happen. I don't think weekly recurring revenues would be happening in that firm. So in my hypothetical direct cash flow statement, I made it over months. And I said that, let's say we made it for the end of year 2021, for the last quarter. We wrote, first of all, its beginning balance, which is directly the bank balance of the firm in the 1st of October. In the 1st of October, the bank balance of the firm is, let's say, $330 million. And then we write down the cash inflows within 1 month. It's quite pessimistic, actually. Maybe they had more cash inflows than that. And then we wrote down the cash outflows of the firm the cash paid for the general administration and sale expenses and repair maintenance, let's say. And then the net change in cash for 1 month is shown. And then this net change in cash is added up to the beginning balance, and it gives us the ending balance. And the ending balance of the end of October gives the beginning balance of November. So in that case, for the fourth quarter of 2021, the ending balance shows the beginning balance of the next year, right? So the ending balance of the end of December 2021 would give us the beginning balance, so cash and cash equivalents of the beginning of the year 2022, which takes place in the balance sheet. These two amounts for sure will match. We cannot always say the same thing for indirect cash flow statement. I mean, in indirect cash flow statements, if we add up the net cash flow to the beginning balance, it doesn't always give us the next period's cash and cash equivalents. Actually, I've checked it in that firm. It is an amount which is quite close, but not directly the same amount. It's mainly because the data used in cash flow, indirect cash flow statement is not as recent as direct cash flow statement. But we can definitely say this for direct cash flow statement. The ending balance of 31 December 2021 is the cash and cash, gives us the cash and cash equivalents of the balance sheet of the next year. The first cash available for that firm. And net change in cash item is mainly used for the calculation of the ending balance. And why do we want to see the ending balance? Because we want to see if there is going to be if there is any cash deficit or cash surplus in that country, in that company. And what do we mean by cash and cash equivalents? Everything which is defined as cash, demand deposit, term deposits, up to 3 months maturity, and checks without term. In Turkey, we don't have checks without term, but in some countries, they use it like cash, even pay salary with it. So those are the things defined. Also, coupons, some stamps can be defined as cash. And the actual amount that it receives from operations, investing, and financing activities is being showed in indirect cash flow statement. The main idea in indirect cash flow statement is actually this categorization and to see how much money it generates, how much cash it generates from its operating activities. And it starts from net income, as we said, and it eliminates non-cash items. Then within those categories, it adds up or subtracts every cash inflow and cash outflow within that, and it is reaching a net cash flow through it. Actually, indirect preparation of an indirect cash flow statement is quite easy. What you need for that is that you don't even need to talk with anybody for that. What you need is just taking the financials of the firm, two periodical periods balance sheets, and also if you take the income statement, you can make the cash flow statement, indirect cash flow statement of that firm without even talking to anyone. So preparation is very easy. And of course, from income statement, you take the net income. And it shows the financial strength and potential growth of the company, especially the cash from operating activities is being used in indirect cash flow statement. So how much cash is being generated, and CAPEX is being checked because CAPEX takes place in cash flow statement too. And we also see that how much of the net change in cash is made from operating activities. For example, in the indirect cash flow statement that we saw, recursion cash flow, it wasn't generating any cash from operating activities. Actually, it's the same for all technology companies. Even if it's not deep tech, if its research and development expenses are high, then for a long while it's not generating any cash from its operating activities. So the terms are a bit longer. Now I will check if there is any question in the chat. Sorry, from here. There isn't any question until here? Okay, fine. Okay, then we can go on. So let's check the details of these activities. What do we count as cash inflow? In operational activities, what do we mean by sales? Actually, the cash inflow from our sales or the decrease in our accounts receivables. For example, if our accounts receivables decreased, it means we had cash inflow from our sales. The term of some of our accounts receivables has came and we got the payment, which is counted as cash inflow in indirect cash flow statement. And decrease in trade receivables, decrease or some other or decrease in inventory or increase in trade payables can be counted as cash inflow. Within investment activities, sale of plant, land, and debts from group firms, debts from bank can be counted cash inflow. And in operation activities, cash used in operations, decrease in trade payables means that we made payment to our suppliers, which is cash outflow. Increase in trade receivables means that we made the sales, yes, but we couldn't receive, or the terms of our accounts receivables has been expanded, so it's counted as cash outflow. So the interpretation of increase in receivables, decrease in receivables and payables is like that, and we will talk about it again in the later sessions. And again, buying plant is cash outflow, dividend payments are finance activities, again, cash outflow. These are the details of this. And what is the main purpose of this cash flow statement? What we are trying to do, we are mainly trying to compare the net change in cash with net income, trying to make two important comparisons, and operating cash flow with net income. We are also making the comparison of operating cash flow with net change in cash, and also the EBIT or net operating profit after tax, or sometimes EBIT, which are not the same actually, with the operating cash flow. So how much we seem to earn from our revenues from operating activities, and how much cash actually we are generating. We made such comparisons. But this comparison with net income is important because they are both about profitability, how much of and sustainability of the firm's strategies. But operating cash flow mainly tells about the short term. We will talk about the details of this. If you check the net change in cash and net income, the companies typically provide a cash flow statements to compare these two terms. We see that the net income is not always reflected to net change in cash. Just like the example we saw in Recursion, it is making a net loss. So net income is negative, but net change in cash was positive, but not because of the operating activities. So from which part of the cash flow statement that generated cash is coming is another important question. And first, also, we should identify the term net income. Net income is the most common item within the three financial statements. It is being created in income statement, and it continues its journey with balance sheet, and also it's it goes to the cash flow statement as a last stop. So it is the common item of all these three, and it's being used in different purposes in all these three financial statements. Within, I don't know if you ever have taken role in budget planning. In budget planning, I've seen lots of firms using different methods, but one thing has never changed, that it always starts from the forecasted revenue, forecasted sales. So it always starts from the income statement, since the income statement starts from sales. Now, let's take I will check again if there is any question, and then we can have no question yet. Okay. So let's go on from here in 10 minutes. See you then. Okay, welcome back. Here I saw a question. First of all, yes, the amounts in parentheses are negative values. They are sometimes demonstrated like that. And about the other question, some amount of creativity is always allowed. You can't imagine also in other industries, creativity is very much needed, but not for balance sheet items actually, but for income statement items while recording to the journal and bookkeeping and reflecting to the income statement within some periods. Of course, some other items can be created, but even if they are quite new items in our income statement, we can still categorize if they are related with the operations or if they are related with other activities of the firm, like financing activities, etc. So in legal reporting, we have to categorize them under some groups. If it's an operational expense or revenue, or if it's a financial expense or a financial return, or financial payment, financial expense, we make those categorizations in legal reports. But in journal, in bookkeeping, we show it as it is. And in income statements, there is more flexibility in demonstrating some different items. But in balance sheet is quite actually less flexible and quite common. And it's mostly about the international financial reporting standards and the accounting standards that you use in your country, and generally they're about this. So you have to categorize such items. Any other question? Okay, thank you. Then we can go on if everything's fine. Let's go on with net income again. As we said, net income is in budget planning. Net income is the one of the main items, result items that we reach and that we will use a lot in budget reporting. And from where do we reach to that net income? Mainly from sales. So we check the sales and the cost of goods sold, and we are checking all gains and expenses booked take place in income statements, and then we take the net of them, all gains and expenses, and when we take the net of them, we see it starts from sales. We see that it arrives to the net income, and then where do we put that net income? We place that net income in the equity, shareholders' equity part of the balance sheet. And it is actually mainly showing what do we owe, what do we own, and what do we owe. And in cash flow statements, it starts with net income, and we are eliminating the periodical differences. And what do we mean by income? Income is, as we said, the revenues from selling services or products, and it becomes an income once we make the bill of it. Once we are billing it, it's an income. Everything billed, but receivable of cash is not counted in income. Any sales that we made, any revenue that we made, may not be generated cash generation for us for that period. And what do we mean by cost of revenue? Again, we are using the income statement of Recursion. Of course, they didn't use the item cost of goods sold. So like you said in your question, sometimes some items can be expressed in different parts. For example, cost of goods sold is being used for manufacturing firms. But for a technology company, since it's not a manufacturing company, cost of goods sold is not an item to be used, but cost of revenue can be used. So this item is probably consisting of the supplier payments made for operating activities, made for the studies of that firm. And it is making it's finding out the first result item, gross profits out of these two. So the total revenue and cost of revenue brings us the gross profit. Of course, research and development is one of the most important items in cash flow income statement. And also the sales and general administration, which includes the salaries of the employees and other fixed costs. And net income is the bottom line of income statement, which is the amount of accounting profit according to accrual accounting base, which is left over after paying all its expense. And the difference between net change in cash and net income, as we said, is mainly because of the accounting systems they are based on. Net income doesn't reflect the amount of cash consumed or generated. Net cash flow is calculated by determining the change in ending cash balance from period to period. And how does it find out the ending cash balances? From starting in two different ways, either starting from net income or by directly taking the related cash inflow and cash outflow data, or either starting from net income and eliminating non-cash items. And if you make the interpretation of that comparison, for example, a positive net income doesn't mean the firm is able to cover all of its expenses. It may not be generating cash. Or an increase in cash in the company doesn't mean it is profitable. Maybe it has an increase in net change in cash because of sale of a plant or equipment, or because of its financing activities, or maybe it is a temporary thing, or maybe it's seasonal. And after executing its operating investment and financing activities, if it's generating cash, we say that the company it's actually good for the short-term liabilities. The company can pay its short-term loans. That's what we can say. So the company will not go in cash deficits for a while. And decrease in cash means the company is not able to cover its expenses, and the company may go to cash deficits if it cannot find any funding. But operating cash flow is more important in order to see the sustainability of the company. If the company is not generating cash from operating cash flow, then it means you cannot provide a long-term the banks wouldn't prefer to provide a long-term loan to that firm, since it is not growing in size in its operations. And how do we calculate the operating cash flow? We calculate it by eliminating the non-cash expenses from net income, adding them up, and then we subtract the net increase in working capital, or what do? We add the net decrease in working capital. While we are going through the net working capital, we'll talk about this. Why do we add and why do we subtract? But these are mainly about the interpretation of indirect cash flow statements about those operating items. And what do we mean by non-cash expenses? Depreciation, amortization, is actually not a cash outflow, but in the income statement, it is being subtracted as if it's a cash outflow, since because of the accounting system of the income statement. And it represents the accrual-based expensing of capital of the company invested in maintaining its property, equipment, website, software, etc. And since the cash has already been spent on these items, the expenses added back in cash flow, because there isn't any cash outflow every year about these items, actually. And there are also different depreciation, amortization methods. So its method is also determined by the firm, and it is not an actual cash flow. Therefore, it's being added back. And stock-based compensations are also added back. Stock-based compensation must be recorded as an expense on the income statement, but there's no actual outflow of cash, actually. Since the company pays the CEO, CFO, and other employees with stock, the company issues shares instead of giving them cash, and this also causes some dilution problems. And there is definitely an economic cost for stock-based compensation, since it dilutes other shareholders. However, when calculating operating cash flow, since it's not a cash outflow, it must be added back, because in income statement also it was one of the items which are subtracted. And impairment charges are also added back. Unrealized gain or loss, or deferred income taxes are also added back. And what do we mean by net increase in working capital? The accounts receivable plus inventory, which most of the technology firms don't have, and minus the accounts payable. And how do we make the interpretation about operating cash flow? First of all, we need a positive operating cash flow, and in order to show the solvency of the company. But there is a parenthesis for that for the deep tech firms, as I said, and even some of the technology firms. Since their accounts receivables are having longer terms, it's not expected from them to have positive operating cash flow in short term, but for more long-term funding, it might be expected, since the studies and pipeline increase and the revenues increase, and the related fixed cost and research and development costs stay stable in those. So the industry is very important in the interpretation of operational cash flow. But it also sometimes, if it's, for example, expanding negatively, it's decreasing, it might be a good sign too. It might be a sign of expansion of the operation of the firm. So it is an item which should be evaluated according to the sector, that's for sure. And it should also be compared with the operating income. So the company might not be generating cash, but is it making any revenue? Is it because of the terms of the accounts receivables? So if the terms of the accounts receivables are too long, for example, it might still be having a positive net income, but it might still have a negative operating cash flow. And it can also be compared to earnings before interest and tax, which kind of also might reflect the operating income of the company. And by comparing those two items, we actually see how much of those sales are generating cash for the company. And also, if we compare it with net income, we see that how much of the net income is coming from operating cash flow. And we should also compare it with the net change in cash, by the way, how much of the change in cash is made from operational activities. So up to here, is there any question? Actually, there's a notification, some notification, so if it comes, I can hear. It's good. But let's check. No. Okay. Then let's go on with cash flow projection. We said cash flow projection is the modeling of the cash flow statements, but actually there are two types of cash flow statements. Direct cash flow statements, we gave example to direct cash flow statement, which is made by direct data being used, collected from related departments, which is the most current data, how much money will come from the revenue, how much we will pay to the suppliers. You call the related departments and you learn your near future. That's direct cash flow projection. And its time horizon is quite short, actually, shorter than 3 months mainly, because the data collection period is quite difficult in the reporting of direct cash flow projection. Since that is very difficult, also the data that you collect from today about 3 months later may not be so accurate. So if it's data of a close future, then it will be more accurate. Therefore, the time horizon of direct cash flow projection is generally starting from 1 day to 3 months. So by 1 day, what do I mean? Every enterprise in the world has to make cash flow projection. From the beginning of the day, they have to make a forecast about how will they finish the day, how much cash inflow they will have, how much cash outflow they will have. So it's for sure starts from 1 day. And some enterprises, the receivables are not received very frequently, like some energy sector and technology, etc. Those type of firms generally use the horizon either 1 week or 1 month. So it starts from 1 day, as I said, but you can also do this for next week and the other week, following week, etc. Or you can do it from today, for example, for April, May, June. It may go on like this, but not for a direct cash flow projection. We can definitely say that you cannot do it from today for next year. And its focus is mainly the ending balance in order to see the potential cash deficits, risk of liquidity in near future, and cash inflows and cash outflows are being generated. And the forecasted ending balance is being seen with this. And what do we see with the ending balance? Our funding requirement and our excess fund, and how do we use the excess funds? We decide on that before the beginning of that period, or how will we find new funds? We decide on that by using cash flow projection. And there are actually different type of cash flow projection reports. One of them is liquidity planning. As we said, we can do it weekly, daily, for maximum 1 month. We check all of the cash inflow and cash outflows of the company. We are trying to make forecast about this. And the currency will be the currency of the payments. That's a very common question. What will be the currency of liquidity planning? For example, they say that we are a Turkish firm, but we make exports and imports, and our imports amount is so high that actually it's the biggest amount which affects our financials. So which currency should we use? For sure, the currency of the payments should be used. But it doesn't mean that you shouldn't make it in local currency. Local currency, first you prepare it in detail in local currency, and then you summarize it in the currency of the payments in order to see your capability to meet your short-term financial obligations. Otherwise, each time you have to make that conversion for each item. If you make it too detailed in a foreign currency, it would be more difficult to prepare. And also debt management is another type of cash flow projection report, which is only made for bank borrowings and which is mainly following up the capital and interest payments of borrowings. Also collateral and deadline transparency and liquidity risk management are other important reports which are being used in order to follow the, again, deadlines. And if we check the frequency and period of cash flow projection, we see that direct method of cash flow projection can be used up to, in practice, 3 months, but theoretically it can be used up to 6 months, but it wouldn't be very healthy because you are directly collecting the data. But in indirect method of cash projection, it can't be used for days or weeks, of course. Minimum, it should be used for minimum 1 quarter, 3 months or more, even for more years. And actually, that's one of the most important things about cash flow projection, the data, the inputs of the cash flow projection. So which items should we directly forecast? Which items should be indirectly projected? And which items that we shouldn't touch at all? It's that's data categorization shows the quality of your cash flow projection, actually, because if you try to make forecast about a result item which should be only calculated from items on top of it, if you try to make a forecast about net income, for example, if you try to make a direct forecast about EBITDA or ending balance, saying that I will make a net income of $1 million in the next quarter, for example, that cannot be counted as a cash flow, as a financial modeling, or you cannot say in a cash flow projection that next month I think that I will be generating $1 million cash from operating activities. Since the cash from operating activities, operational cash flow, is a result item which is being calculated from items above itself, you cannot make a direct forecast about it. Even if you have an idea, even if you have a story, it would never work in a cash flow projection or financial modeling. And for some inputs of cash flow projected are indirectly projected, like the receivables, for example. Without having any idea about sales, how can you make a forecast about receivables? It's impossible, right? And it's the same for payables, actually. So if you are going to make an amount out of your mind, make a forecast directly from your mind, for example, you can that revenue is the item that you should do it, actually. Revenue is like the sun of the universe, and without it, the word wouldn't exist. Without it, all those other items below wouldn't exist. So if you are going to make up something from your mind, it will be the revenue of the following periods. It should be about the customer expansion. It should be about new customers you'll have. It should be about customers that you might lose. Your competitors will bring new technologies maybe, and you are going to lose some part of your market share, etc. If you are going to make a direct guess, it should be something about revenue. Also, you can make a direct forecast from your mind about CapEx. You can say that I will invest in plant and equipment this much I'm planning, and if I don't have enough money for that, if I don't have enough assets for that, I will borrow, I will use equity or debt financing for that. It's again okay. You can make direct forecast about that. Fixed costs, yes, you have to make a direct direct forecast about those. For example, next year, since you are determining the salaries will be like that, and you should also make a projection about the cost of utility and other fixed costs like energy, etc. Of course, you have to make some direct forecasts about those items, since there isn't any other related indicator in your financials about this. And again, marketing expense is something you directly decide, so you can make a directly projection about this. But you generally make the assumptions, make the forecasts of those capex, fixed costs, and marketing expense again later, after you make the main forecast about revenue. Actually, revenue forecasting the revenue is half of the business. In Turkish, we have such a saying: starting is half of the starting is coming out half of the way. It's just like that. If you make the correct forecast about revenue, then this cash flow projection will become more accurate, and this financial modeling will become more accurate. Why do we say, why do we start from revenue in a cash flow projection, you might say? It is because the cash generated from revenue is related to the cash flow projection, and also in budget planning, we are making, of course, a projection about the income statement, and we are making a forecast about all of the revenue, even if it's cash generated or even if it's reflected from receivables. So for sure, all projections start with a forecast of revenue, and up to that projection, you decide on the story of the firm, and then you decide how to make a projection on the other directly projected data. And the indirectly projected data, like receivables, payables, are all related to those directly projected data. It can be some ratio of them, it can be some part of them, or it can be made by an adjustment through them. We'll go over this also. And all operating and OPEX income. And the result items, we don't even touch the result items. Result items are just formulas, and they calculate the result of all those projections that we made. And what are the assumptions? Assumptions are forecasts, again, about the economical environment and some systematical risks. For example, if there is a risk of a war, risk of a disaster, etc., you can also add this to your cash flow projection and financial modelings. And of course, we make some assumptions about the tax rate, which are always default, and growth of industry, etc. These are also being used. So, is there any question up to here? Let's check a cash flow projection of a software as a service firm. Let's say it is made on monthly basis. And let's say we are at the end of year 2022, and we are making a forecast about the following months. The cash inflow from those revenues are being shown at top of it, and we say that there are 3 types of revenue generating partnerships, let's say, and we are making a forecast about each one. Of course, this can be coming from some other sources too. Revenue can come from some royalty fees and some consultancy revenues can be earned. But let's say that all cash inflows are like that for this example, but we'll see more detailed examples about this too. And at the downside of it, we see the cash outflows, mainly from services, supports, and also customer success, and COO salary is also counted as cash outflow from operations. And the research and development, sales expense, marketing expense, G&A expense are also counted, and all the operating expenses are being counted. And this is calculating mainly the ending cash from all operating activities. What is missing there? 2 things are missing there. The financing activities and the investing activities are missing there. It's not shown. It is just to make, just to see how much cash outflow is coming from the operations of the company. While talking about the techniques, we are going to see it in more detail. What type of methods do we use? One of the methods that we use in cash flow projection is the ratio approach. First of all, let's say that we came to the end of this month, March year 2022 and 23. So this year, March, at the end of this March, we are planning to make a forecast. So we have the actual data of the first 3 months. So what do we mean in ratio? Well, what do we do is mainly about the previous actual data. Here in yellow, we see the actual data highlighted. And here we see how much change has happened to revenue A. And we see that revenue A has increased in February and then decreased in March. And we make our projection from here. Per month, we say that in April we expect this much of increase, in May this much of increase, as a ratio of the latest actual data on it. So, and then we calculate it accordingly, as you see. So this is one of the ways. And we do the same thing for the cash outflows. We expect this much increase or this much decrease. We say, for example, COO has decreased up to a level, and up to that level, they expect a little increase, and then again, it stays stable. So if it's stable, you don't do anything, and it stays as it is. This is the ratio approach to cash flow projection. You can do it to every history. For example, if you're in the middle of a year, you can use it for the rest of the year. It's one of the ways. We can another method for cash flow projection is the adjustment approach. Those are the methods that we use by using the latest actual data, because latest actual data, historical data, is always being used in cash flow projections if it's not a startup, if it's not a newly established firm. And we take it as a reference, of course. We don't directly take it, but we take it as a reference. And in adjustment approach, for example, we focus more on the story. We say that in this month, we expect such a thing to happen, which would add this much amount to our revenue. In this month, we expect such a thing. So we go over events one by one. So it's more difficult than ratio approach. And if you go to the model, I will go to the model again. In adjustment, we do the same thing mainly, but we do this with amounts. So it says that in April, because of this, $5 million will be added, or $5,000 will be added. In May, this much amount will be added, and it is being used for each month following each other. So it's added to the previous month, or it can be also subtracted. It's the main idea of adjustment approach. And another approach is scenario analysis. Actually, all those approaches are generally used together, by the way. While making a cash flow projection, you don't say that in that cash flow projection, I will use the ratio approach and I will project everything with ratios. You don't say that. You decide it from item to item. So each item, you might use a different approach. If it's a very important item, you might even use a scenario analysis on that. And in scenario analysis, 2 or 3 different scenarios are being simulated for that item. If it's 2, generally an upside case and downside case. If it's 3, upside case, base case, and downside case can be used. And in our model, if we check, then we make a live scenario for that. So what do we mean by that? Let's say for the following months, we made upside case of this, a revenue growth, which is up to change in revenue. If it's going well, things are going well. If everything's fine, we expect these increases in revenue. And sometimes we do it with adjustments, and also we expect this as the amount of COO salary, for example. We can either use ratio or amounts, but we draw a picture here. And if things are not going fine, then we expect this much revenue growth, and we expect all these things. And then over those scenarios, we decide for each period which scenario will come true. For example, we say that in April this year it will be an upside case. So things will go well. But in May it will be a downside case. Things won't go that well. In June it will go well again. You make codings for all these, and you make a live scenario for each. So for each situation, you submit the related scenarios consequences, and according to this, you make a link this with the actual data you have. And for example, in April, that it will be a good month. So a good scenario is upside case is working there. Therefore, there is an increase, high increase. And in May, it won't be that good month. So in May, the revenue will not increase that much. For every period, you can do this. And it doesn't have to be ratio always. It can also be some certain amounts. We say that if it goes well, we are planning to spend $100 million in research and development, and if it's a downside case, $110 million. So you decide on everything according to all these scenarios. So those are the main ideas. And why do we do it? We do it because we have 2 scenarios, 3 scenarios, and we want to see how our ending balance will be reflected, how our EBIT will be reflected. That's why we use those scenario analysis. There are also some other ways that we can do. For example, for startups, which doesn't have much historical data or didn't start to have any revenue yet, historical data cannot be used, right? Historical data can be used for firms which are existing for a while. So What does those newly established firms do? They can use the historical data of a peer, and they can make direct forecasts about it. But here you might ask the question, I mean, if they are newly established and if they want to find a peer, how will they find the historical data of a peer if it's not listed, and generally it's not listed? So they can just take a company which is smaller in size, a company which is subsidiary of another company might be a solution in order to take some examples, or instead of doing this, they can have industry averages. I mean, if they cannot find historical data of a peer because all the peers are listed and quite big in assets, then they can actually follow up the related indices, the related sector averages, industry averages, and from those industry averages, that company can make direct forecasts by making some assumptions. So the main idea is learning it from the market itself, because you don't have any historical data, and it can be used with some other also cash flow projection methods as a hybrid model. And another way of projection is projection out of the historical performance, which means that what did we target in the previous year, and how much of it could we achieve. So it is generally used in the middle of the year. For example, if there is only one quarter left for this year and you don't know how to make forecasts for the end of the year, it can be used for some items. Not all of them, but for some of them, because you don't make targeting for every item. All those methods I've told also can be used for specific items, and they can be used in hybrid models, and it is one of them. So the historical performance of the firm in reaching out its targets is being used as a reference in projected items. If you give an example, of course, you don't do that in revenue, but let's say you don't have any idea how will that year will finish. You do it with actually less important items. But let's say that you did with revenue, and you have in last year you had a target revenue of $100 million, and the actual revenue happened to be $70 million, which means that you could only achieve 70% of your targets. And every year you do it like that. You do the same, and you don't have any idea how you will finish that year. So this year for 2023, target revenue was $200 million, and by the end of the third quarter, the year-to-date actual revenue was $100 million, which means that you already came to the end of the 9th month of the year, and you don't have any idea how will you finish the year, and you are trying to make a forecast about the annual revenue by the end of the year. So since you are generally doing 70% of your targets, it means you are going to make $140 million annual, yearly. So for the last quarters, you have to make $40 million more. But if the actual revenue year-to-date actual revenue was already $150 million, for example, in that case, then this method wouldn't be working, of course, because you already exceeded your target, so you don't have any other reference for it anymore. Let's go over the relationship between cash flow projection and net working capital. Those two items have a consequence of free cash flow, which is being used in business valuation. Free cash flow is the money the company has left over after paying its operating expenses, OPEX, and capital expenditures. And what is the difference between net cash flow and free cash flow? Net cash flow is the change in the cash balances. excluding the long-term debts. For example, it is for a certain period, and if within that certain period there isn't any cash outflow, that long-term debt is not counted in net cash flow. But free cash flow counts the long-term debt with its principal and interest payment too, if it's levered or for the shareholders while it's being calculated. And within that amount, it is trying to find out the cash amount which is left for the stockholders after the extraction of all expenses from revenue. And if we compare it with the net income, the net income is a measure of profitability, as you know, but it is not telling anything about cash generation. It still has cash, lots of net income has lots of non-cash items. But free cash flow is again a measure of profitability because it is the amount left to the shareholders. And adding to that, it is excluding all non-cash expenses. Therefore, we call it a cash flow. Otherwise, we wouldn't be calling it cash flow. If something is defined as a cash flow, it should be excluding all non-cash items, we should say. And free cash flow is an important item for DCF analysis that we will talk about. And for example, this is a logistic technology company, DoorDash, which is an United States-based company, and we are now seeing the free cash flow forecasts about it. How do we use those free cash flow forecasts? We are discounting them with the weighted average cost of capital or any other discount rate that you determine to today, and we are finding the present value of the free cash flow, which is used as an item in the calculation of the implied enterprise value. As we said, it is the leftover, what is left over in cash from OPEX and CAPEX. So the present value of free cash flow is being used for that sum. And if you have any question, I can take it now, or we can have a small break if you want. No questions, as I understand. Then a 10 minutes break, then we continue from there. Then we can go on if you want. As we said,
you can start.
Yes. As we said, free cash flow is being used as an item. Some of the present value of free cash flows is being used as an item. And here, this is just one of the ways of calculating the free cash flows, but there are also some other ways, starting from net income or started from earnings before interest and tax, after and then adding the interest on tax on interest shields on it, etc. So there are three main ways of calculating it, and it has as you see in the formula, there is always a change in working capital added. Then, if there isn't any question yet, we can go with net working capital, which is also one of the items in calculation of the free cash flow. Net working capital is a very important financial benchmark, measuring the financial efficiency and the liquidity risks of the firm. So it is mainly being used to see the firm's capacity in meeting its short-term liabilities. There are two main definitions of net working capital, and both are correct actually, but they are being used differently and they are being interpreted differently. According to the broad definition, net working capital is the difference between current assets and current liabilities. It is a direct measure of the liquidity risk of the firm, and short-term, it's able to meet its short-term liabilities. And according to Nerov definition, it is the accounts receivable plus inventory minus accounts payable. So it is the fund requirement. That amount is the fund requirement out of the operations of the company. So how do we interpret it? As I said, we are interpreting those two different formulas differently. The first one is the company's a measure for the company's solvency to meet its short-term liabilities, and it's generally being compared with the current ratio. Current ratio is, we will see in a few minutes, is one of the main liquidity ratios of the firm, and that's the first thing that the banks check while when they are deciding on financing a company or not in short term. And if that amount is too high, if that, according to the broad definition, if the difference between current assets and current liabilities, if it's too high, it means the firm is not making any long-term investments. And if that money is positive in broad definition, it means the main question here is that, is it able to cover its short-term liabilities? And the answer is yes. So with a positive net working capital, if it's not too high, generally a short-term loan would be given to a company. But it's not interpreted the same way with the narrow definition, because actually that amount, so that accounts receivable plus inventory minus accounts payable, is a funding requirement, represents the funding requirement of the company within its cash cycle. And what do we mean, the funding requirement within its cash cycle? So in the cash cycle, a company, when it starts a new operation, let's say that you have a new partnership, you have a new collaboration, a new study to start. And what's the first thing you'll do? You will go to some suppliers and you will make some payments, right? So you will make some initial investments for every study that you will make. And that initial investment is the money, the cash outflow from operations. And what you expect from that investment, you expect to receive your revenue as soon as possible. And if you made the payment and the time period between you made the payment and you receive your revenue is actually your funding requirement for this operational activity during this cash cycle. And it should be compared, this amount should be compared to always total assets of the company. A net working capital amount in broad definition might look high, and you might say that we are able to borrow from banks in short term at least. But even if it looks high, if it's like 10%, for example, or lower than the total asset size of the company, then it's not high for your company. So all the amounts in financial analysis should be compared to a reference value. And reference value and the comparison of net working capital is the total asset size. And also the peers' net working capital should be a reference. Their net working capital over total asset ratio is also being used. And also for broad definition, current ratio is being used. And what is the main target here? Since the technology firms generally don't have much inventory, as far as I could see from their financials, minimize the term of the trade payables and minimize the term of trade receivables and maximize the term of trade payables is the main target in net working capital management. And how does it reflect to our cash flow statement? It's easy. The increase in change in working capital, the increase in working capital would be normally the accounts. I mean, if you want a cash inflow, then accounts receivable should be decreasing, and the decreasing accounts receivable would be the increase in accounts receivable would be a cash outflow. What is the interpretation of it? If your accounts receivable increase, it means you have received some of those receivables.
Sorry,
so also a fall in inventory and will shows that you made sales. It's cash inflow. So from your perspective, since you don't have inventory, accounts receivable decrease, then it's cash inflow, and increase, then it's cash outflow. Accounts payable increase. It means you have extended the term of your debts to the supplier. It's perceived as a cash inflow, and opposite is like that. And it is the cash cycle is the time that your company needs funding from the day that you paid to the suppliers until the day that you receive your revenues. And net increase in working capital means actually the increase in accounts receivables, increase in inventory, and increase in accounts payable. How it's interpreted is the same way like that. Every increase in accounts receivable is a cash outflow, and increase in accounts payable is a cash inflow. So if we go on from here to the liquidity ratios, the main common parts and one of the most important efficiency performance indicators. There are three main liquidity ratios of a firm, which are current ratio, acid test ratio, and cash ratio. And acid test ratio is actually not containing any inventory, which can be used for technology firms better, because also liquidity of inventory is not known, and also the valuation of the inventory is according to the accounting system. And this amount, so this is the cash and cash equivalents plus short-term trade receivables, account receivable over short-term liabilities. It's more functional, as I said, for technology firms, since there isn't any inventory. So how much of the cash and how much of the accounts receivables is covering the short-term liabilities, and that's why maybe Recursion is keeping this much of cash. And cash ratio is another performance indicator, which is actually in case of a liquidation. Let's say that a bank called back one of its debts, one of the debts of the company. From today till next week, it has to pay it back. And in such a nightmare scenario, what would the firm do? It would use all its cash and cash equivalents because it can be that item can be used in the shortest term. It's having the highest liquidity level. So it is another ratio which shows it. And current assets over short-term debt is the mostly used liquidity ratio by banks, and it is always compared to net working capital in broad definition. And the main aim is to demonstrate the liquidity risk of the firm. How we are using them together? Let's say we have two companies here, and let's put ourselves in the place of the bank, and those two companies both ask for a loan, and we are checking their current ratios. The current ratio of company B seems to be higher, but actually just by looking at its current ratio, we cannot give 1 million Turkish lira loan to that company, since its net working capital is only 50,000. Okay, then here we see that we should also check the size, the amount of the net working capital. We shouldn't only decide by looking at the current ratio, since the total asset size are different. And also we should check the liquidity level of each asset. For example, here there are two firms which has the same current ratio, but the liquidity level of their assets are changing. One of them has too much current assets, and the other one cash assets, especially securities, and the other one has some inventory. Mainly its current assets are concentrated in inventory. And in the short term, in the loan decision of a bank, a company having a current ratio like 4, for example, when this industry average is 1.5, is too high. And if a firm requires a short-term bank loan, for example, with that high current ratio, the bank would probably first calculate the net working capital. That firm requires $2 million, and it has current assets of $2 million, and its current ratio is 4, which means it has 500 short-term liabilities, 500,000 short-term liabilities, and its net working capital is $1.5 million. So in that case, a $2 million short-term bank loan would easily be given to that firm. But for a long-term debt, the bank would think again, because why the current ratio of this firm is this much high, and why it didn't make any investments to any property, plant, or equipment to expand its business would be the question that bank would ask. And if we go on with the cash ratios, we can also make comparison of cash from operations with short-term debt. You remember cash flow from operations was taking place in the cash flow statement, and in risky environments, this should be accepted as 40% would be good for that. But of course, it changes from sector to sector. Like in technology sector, you cannot expect it in short term. And also in deep tech, short-term loans may not be this much required if it is making continuous studies for long-term projects. Then maybe long-term financing would be a better solution. And also cash flow, how much of this increase in cash is coming from cash flow from operations is another question. And cash receipts from sales. How much of the cash, how much of the revenue is turning is cash generating, and how much is turning out to be accounts receivable. In cash ratio, the cash receipts from sales, as we say, how much of cash from is generated from each sales, and is divided to cost of goods sold or cost of revenue, are payments to supplier. It's preferred to be higher than 100%. So up to here, do you have any questions? If not, we can go on. As we said, the main idea behind cash flow statement, cash flow projection, is to be able to see the firm's capacity to meet its short-term and long-term liabilities. And if we see, while making cash flow projection, if we see any cash deficits, there are different opportunities, there are different solutions that we can follow, which are debt finance, equity finance, and hybrids of these two solutions. And these two solutions, debt finance and equity finance, we have already talked about. Debt finance can be made in different ways, short-term, long-term, and the performance evaluation of the company is being made. For short-term, some liquidity ratios are being checked, but for equity finance, evaluation is made to the firm. And hybrid of these two, debt and equity finance, is mezzanine financing, which gives the lender the right to convert the debt to an equity interest in the company in case of a default, or sometimes it's like convertible bonds, some mixed solution, and they can carry higher yields than ordinary debt, and they are generally unsecured debts, and those loans subordinate to senior debt in priority. So normally in payments, in case of any liquidation, the debtors, the lenders have priority over the shareholders, and these are the mezzanine loans are subordinates to debt, so they are like senior debt. And in debt finance, it is, as we know, debt raising, when firm raises money for any type of need, the working capital or capex need, by borrowing from a financial institution or selling debt instruments to individuals or institutional investors. And what is good about debt finance is that in case of a bankruptcy, in the payback scheme, the lenders have priority over shareholders, and debt financing, the lenders know always they return. There isn't any risk of losing all the money. The interest return is always known. And another part of another importance of debt finance, it doesn't require ownership. But in equity finance, it requires ownership, and is generally made during the startup stage to finance the main plant assets and initial operating expenses. Pardon. And it is actually being a partner to the firm. And how do we decide, and how does the company decide the optimization of these two, the weights of debt finance and equity finance in capital raising? There are different advantages of both. Let's say that we have an investment of $100, and we are expecting an earning within 1 year of $8 to $14 from it. So we already want to invest $100, but we didn't decide to whether to invest, whether to borrow it from banks or whether to provide equity financing. So if we pay it all from our equity, if we don't borrow at all, then the equity financing will be $100, and the lenders won't earn anything. If we borrow it, the lenders would earn 10%, and earning of the shareholders, earning for us, let's say we are shareholders, would be from $8 to $14 as we expected. And in such a case, the return on equity would be 8 to 14%, and return on investment is again the same. But if we finance half of it with debt financing, then I should pay $5 to the lenders because of the $50 debt that I had from them. So $5 will be subtracted from the expected earnings, and what will be remained, $3 to $9 will be the earning of the shareholder, which makes the return on equity a bit lower, in 6% or 18%, or in return on investment 3% to 9%. The formulas are shown in the formula row. And in the third case, if we decided the firm to have high leverage, and we want to borrow most of it, since the debt financing is high, then its return on equity would be high, because I invested a very little money, and I've earned up to 30%. And return on investment in such a case would be 0 to 6%. So it all depends on how much leverage you want to have within your investments. If you try in your investment and if you expect a high return, then you can use some leverage, and you can have leveraged return out of it. In the third scenario, it only invested 20% of it, and the shareholder has earned up to 30%. So it is all about how much return we are expecting, and the cost of borrowing and their comparison. And what do we mean by return on equity? Return on equity is mainly the net income that we earned from our stockholders' equity, from the equity that we invested on that company, and it is a certain performance indicator for profitability. So if it's higher, it means the firm is generating income. And return on investment is a measure of the investment's profitability. And if you check the advantages and disadvantages of those two, in debt financing, as we said, there's no ownership, and the advantage of debt is that it has a priority in paying, in a payback scheme in case of any bankrupt, and in equity financing, there is less risk than debt, and it's a long-term investment, and investors get some ownership. And in equity funding, there are some rounds in and stages from the startup level until the IPO level. All those stages can be followed, and the beginning of this stage is pre-seed funding. At this stage, the startups develop a prototype, and their product is not in market yet. And what they are doing here is mainly they are collecting from their families, fundraising from their friends, and sometimes angel investors or incubators. And it's seed funding. It happens after the pre-seed funding, and it's that you already had a prototype, but the product development and market research you didn't make yet. So you have to find the target audience for your prototype. And seed funding, seed financing is mainly made by angel investors who are individuals, different than venture capitals, individual investors who are interested in such risky startup firms. And about the amounts, those are the amounts for the beginning of this year for United States, and these are the pre-seed is between $50,000 to $250,000, and seed is between $500,000 to $2.5 million. But the valuation would be different. I'm talking about the funding amounts in the beginning, and it can be collected from several investors, and you will see an example for it. And what should be made for pre-seed, a viable, minimally viable product should be made, and for the seed, a product market fit should be made, and also the assembly should be made for a high quantity team. And a revenue is not expected in pre-seed, but a revenue is expected in seed, and the valuation is between 1 million to 3 million, and the other one 5 to 15 millions. So how long is the horizon of the project? Its target runway is to 3 to 9 months, and in the other one 12 to 1.5 years. And it goes on with the A-type series funding. And after you had your series fund, generally in pre-seeds, you know about the listed companies. If we check from where they were funded from the beginning of their story, we cannot have an idea about their pre-seed fundraising. Maybe they even made equity funding, you cannot know. But in seed funding, you can see some venture capitals and angel investors. But afterwards, generally, the story goes on with venture capitals. And in Series A rounds, generally a business model has been developed, and there is a leading investor in Series A, and this leading investor is also helping the company in raising funds from other venture capitals too, because it has invested in it, the biggest amount of it at least. So it is also presenting the company to other companies. And in Series B rounds, the firm is still being expanded, and for this expanding and growth, even higher valuation is being made for the company. So also late stage venture capitals. Some of them are interested in early stage startups, and some of them are interested in late stage. So venture capitals are playing role in A series and B series funding. Venture capitals are mainly financing startups and businesses that share high risk but also exponential potential growth. And they can be early stage or late stage venture capitals. And in C series, it's also getting ready for an IPO. Before IPO, maybe it is making an investment. The firm is making an investment, maybe buying some other little startups and investing to itself. So in Series C funding is doing well and expand to new markets and geographies and acquire other businesses is the main idea in C series funding. And the valuation typically raise around 26 million, and the company's valuation is around 100 million and 100, and of course we are not counting unicorns here. So 100 million and 120 million valuation is being used. And in these series, it can be a downside, actually, down round for the C series. It wanted to go to IPO, but it couldn't go yet. So it can go for a D series. And even if it's not a down round, it is for sure a preparation before going public for the company. Okay, normally crowdfunding has three types. Crowdfunding is a method of raising capital through the collective effort of friends, family, or individual investors, and this approach taps into this efforts in a large pool of individual investors via social media and some other crowdfunding platforms, and it can be donation based or reward based or equity based or lending based. So there are 4 types of crowdfundings, and that reward based or donation based are having lower volumes, but equity based is, for example, having higher volume, and also in lending based it can be for higher volume. And in equity crowdfunding, the company is offering equity stake, and it can raise from $50,000 to $10 million, and it is available to all accredited investors. Accredited investors means investors having a certain amount of income or portfolio, which is determined by the Securities Exchange Commission or the Capital Markets Board of that country. So it is having a higher volume than other crowdfunding types. And if we check what is being used in Europe until the second quarter of last year, we see that the Series B funding has been used up to 30, with a median of like $35 million is the median value, of course. And the Series A funding was being used up to $11 million. And seed funding was generally seems to be below $5 million. And if we check the Recursion investors and funding, the Recursion Pharma's funding started from seed and pre-seed levels, and as we said, it is not very transparent, the pre-seed, seeds, and even Series A financing, because those can all be made by angel investors and in some individuals, so you cannot learn the exact amounts, but some of the venture capitals are being known and taking place here. Those are some of the venture capitals which invested in Recursion. It was established in 2013, and until in the first 4 years, it's used pre-seed, seed, and Maybe it also used Series A funding. We don't know. Maybe it directly started using Series B funding in the 4th year of the company. And in the 4th year, it raised an amount of $60 million. And in the 5th year, it made a debt of $20 million. In the 6th year of the company in 2019, it collected Series C. So here we see it kept from the 4th year of the company until the 5th year and 6th year of the company. It always found equity funding. And what did it do with this funding? It's actually acquired another company, Vium Medical Technology, which was working in the same area, and for the amount of 96 to 144 million with an acquisition. And so it expanded, it increased its growth, and after increasing growth, it went for a Series D funding. So it got ready for an IPO with that last funding. And with that last funding, also the valuation was a reference to its value. And next year, it went to an IPO. And in that IPO, that valuation was doubled, even more than doubled. And by October of last year, it also sold some of its stocks, made also a sale of its common stocks with a private placement, and it made it to a limited group of investors, and with the leadership of Kinnevik. And the total funding, except the IPO and except the bank debt, was $587 million. So up to here, do you have any questions? Then I'm going on with the basics of the business valuation. In business valuation, there are some basic appraisal concepts. For example, the business valuation is performed by the generic owner, and that both buyer and seller are well informed, so there is transparency. The assets will be in its best use. So if you are acquiring a company, you cannot say that I won't use that part of the firm. Yes, I'm buying it, but since I won't use that department, I'm not pricing it. The acquirer cannot make such an approach. And both sides should be volunteer, of course. It shouldn't be a hasty sale. And both sides should be unrelated, because there wouldn't be any favor one side do to the other side. And both sides should have necessary financial sources. Even if it doesn't have financial sources, it should be that both sides should be able to borrow this from banks and other investors. So in business valuation, why this valuation is so much detailed, and why this valuation is trying to be made very accurately, why all the equity investors are following this valuation, because it can cause great losses, and any hidden, distorted, misinterpreted data and any wrong forecasts might lead to very big difficulties. So the possible consequences of misvaluation can be huge to a company, like big impairment losses and sudden fall in stock value, and even bankruptcy. There are some examples for that. For example, Hewlett-Packard in year 2011, actually it also changed, that company also changed after 2015, but in year 2011, before its spin out, the Hewlett-Packard purchased Autonomy, a UK-based company, with a purchase price of $11 billion. And 1 year later, HP has accused Autonomy of manipulating the recording of its sales to boost the value of the company, which was actually $2 billion. And it has announced an impairment loss of $9 billion. So due to the acquisition, and Autonomy claimed it was misinterpretation of the accounting system, but normally a change in accounting system doesn't cause such losses. So this is one of the examples of hidden or misinterpreted data, one of the huge effects of misinterpreted data. Or American Online, for example, again acquired Time Warner in year 2001, and the capitalization of the combined company has reached over $150 billion, the internet booming season in the world. And that's why all the companies' stocks about that area is booming. And that astronomical profit expectations of investors didn't last long. And after a while, people came to their senses, and it was realized that the future growth expectations for that new company was over-optimistic, and the value of tech companies has dropped by 50%, and the investors realized their loss, and the fair value has had a sudden fall. So these are some of the examples. Also, there's an Enron example in which the company has made some accounting tricks to conceal the losses, and it ended up with bankruptcy. So since it's determining the equity value, the business valuation methods being used and the accuracy of the data is quite important. And what kind of business combinations can be made? A merger can happen. Company A can absorb company B, like the Starwood hotels absorbed the Sheraton and Caesars Palace in '98, and only leaving itself in existence, like Starwood hotels only left. Or in consolidation, like Mobil Oil and Exxon has agreed in 1999, and reconstitute themselves as ExxonMobil, and neither of the two companies exist anymore. So both companies combined and made a new company. Or a joint venture can happen. Only in one area they may work together, like Barnes & Noble made a joint venture with Starbucks, and they are placing that coffee chain in their bookstores. And acquisition acquisition, company A acquires company B, and they remain separate, but company B might be is a subsidiary of that, is a group of is a subsidiary of that acquirer, actually. And as an example, Microsoft purchased LinkedIn in year 2016 for $26 billion, and the two entities are still separate. And Microsoft simply owns a majority of LinkedIn's shares. Another way is amalgamation. In that one, the company A acquires some of company B assets and stocks, usually dissolving after company B afterwards. So as an example to that, Google acquired most of the assets of YouTube as a startup for $1.65 billion in year 2006. And now YouTube is merely like a service offered by Google, but not an entity itself. And what are the main methods in valuation of those enterprises? There are three main methods: the cost approach, the multiplier approach, and the discounted cash flow analysis. Cost approach is mainly used to understand the minimum value of that company. It is used for very big group companies having lots of subsidiaries, for example. For the subsidiaries, they use cost approach, since a business valuation cannot be made for every little entity. And it is actually measuring the cost to replace. And there are three main items that we check in cost approach. The book value of the item, So mainly it's shareholders' equity. The difference between its total assets and total liabilities gives us the shareholders' equity. Another mostly used item is adjusted net asset value. It is actually an adjusted version of shareholders' equity. And how do we adjust it? We are first adjusting the items in total assets, and then we are adjusting the items in payables, and then we are equalizing the sum of them. Since the sum of total liabilities and shareholders' equities should be equal to total assets, then we are finding out the total adjusted value of the shareholders' equity. And the liquidation value is the net value of company's physical assets in case of a liquidation. Of course, a company's equity value shouldn't be less than its enterprise value, shouldn't be less than its book value. So book value can also be taken as a reference for the minimum. The discounted cash flow model is a type of model which values company by forecasting its free cash flows, as we have seen in the previous sections, and discounting them to a present value. And then in discounted cash flow approach, we see how much cash is being generated, and then how much debt is that company has. And if we compare with other investments, what is the enterprise value of that firm? If we see an example here from DoorDash, we have already seen the present value of future free cash flows from the perspective of an analyst for the next 5 years, 4 years, and plus, let's say. And we edit with a terminal value, which is making the assumption that the growth will continue, a stable growth will continue for the rest of the lifetime of the firm. And we are adding it, we are taking the present value of that terminal value, and we are finding the implied enterprise value, and then we are adding the net debt of the company, which is the total liabilities minus the cash and cash equivalents. And then we find the target enterprise value, and we compare that, we divide it with the total number of equities and compare it with the stock price, mainly in making a equity analysis. But of course, all these items are calculated differently, and the calculation of the free cash flow might be in different ways. There are 3 main methods for that. So which method is which method should be used for which sector should be determined, and also which discount rate should be used, should be determined. And the implied enterprise value is calculated like this. As I said, the present value of cash flows and the present value of terminal value. And once the discount rate increases, the value, implied enterprise value, decreases, which means that that enterprise is risky. In risky enterprises, it is higher. And in multipliers approach, the main idea is that similar assets sell at similar prices. So it's a ratio comparing firms with their, some ratios are being used comparing firms with their operating margins, cash flows, earnings, book value, and revenue, sales. And taking the industry average, by using the industry average, the potential price of the equity of that firm is being calculated. And there are 2 main categories of valuation in multiples. One of them is valuation with price to earnings, and the other one is valuation with price to earnings and enterprise value. And equity multiples are price to earnings, price to book value, and price to sales ratio. And if we check the price to earnings ratio, it is price per share over earnings per share, in which earnings we mean the net income. And how do we calculate it? We are taking the average PE ratio and we are calculating it with the earnings per share of the firm, and we are reaching an initial price of the firm per share. And if it's calculated also by dividing net income to earnings per share is calculated, dividing the net income into total number of shares. If we see an example from Microsoft, Microsoft was established in 1975, and in year 1986, most of its peers were public, and at that time, Bill Gates was 65% having shares of 65% of it, and it was also the CEO. And Bill Gates decided also to make an IPO for the company with the investment banks. And at that time, the average PE ratio of the competitors was 15, and the earnings per share of Microsoft was 1.1. So according to those calculations that I shown, price to earnings ratio, the initial price estimate of Microsoft shares was $16.5 per share. So the sector average is 15, and earnings per share is 1:1. And if you multiply these two, the first estimated price was 16.5. But then Bill Gates started the roadshow with the investment banks, and the roadshow raised too much interest. And in the roadshows, you also ask the investors their idea about the price of the company, how much they would give for the company. And the price estimate of Microsoft shares was revised to actually even higher than 21. The investment banks told Bill Gates to make it $24, but Bill Gates started to stay in the conservative side, and they decided to go for the IPO with a share price of $21. So you see that according to the multiplier approach, it was calculated $16.5, but with the high interest of the investors, it raised up to $21. And on the first day of trading of Microsoft shares, the equity closed the day with $27.75 per share. So that shows us that also the story of the company, the CEO of the company, and the credibility of the CEO of the company, and the trust of the investors is also having a game changer role in the business valuation. Another important indicator in multiplier approach is the price to book ratio. So it's mainly, I did the same thing on the third time, it works. I don't know why. So price to book ratio, in price to book ratio, the market value of company over book value of company is being measured. Of course, the price to book, the price of the company per share should be book value of the company, should be higher than book value of the company per share, because as we said in the cost approach, book value is the minimum value, minimum possible value of that company. And the return on equity, it's one of the indicators that it's being compared with. If the return on equity is higher than average, the price to book ratio should also be higher than 1. If return on equity is lower than average, it can be also lower than 1. So we have a company having price to book ratio 1.6, and return on equity is also average 0.7. It has average. If it's average, then we can make a guess that if its return on equity is average, then the price per share of company is multiplication of that average industry ratio with that book value. And we can also divide it with the number of shares and reach the book value per share. And price to sales ratio is mostly used for the newly established firms, since they don't have any sales revenue, and since they don't have any income, they can take it as a target, as a reference, and it's the same price per share over revenue per share. And we multiply the revenue per share with the average ratio of the industry. If we give an example, if the price to sales ratio of the industry is 2, and if the sales of the company is $8,000, the total value of the company should be $8,000 multiplied by 2, which is $16,000. Of course, as we have seen in Microsoft example, there are some exceptions for every approach and also in multiple approach. WhatsApp acquisition is another exception of business valuation, which happens a lot in technology firms. There are lots of factors affecting business valuation. In year 2004, Facebook has acquired WhatsApp, and the original purchase price was reported as $19 billion, and most of the payments were made from by Facebook stock in form of Facebook stock. And as the deal was finalized, the total value of WhatsApp raised up to $22 billion because since Facebook is making the payment with Facebook stock, on the last day, the equity price, the stock value increased with a moment. And also that's made a hit to Facebook, $3 billion hit. And if we check the financials of WhatsApp, which was sold for $22 billion, actually its annual sales was only $10 million. Its net income was minus $138 million in year by the end of year 2013, and its book value of equity was minus $430 million. So it was having loss, and it used to have loss for such a long time that its book value turned negative, its book value of equity, and its annual sales was only $10 million. So why did Facebook paid $22 billion to a company having such financials? Its sales seems to be quite low. Its price to earnings ratio and price to book ratio are not functional. They are both negative. And its price to sales ratio, according to that amount, $22 billion, should be 2,222. So any price to sales ratio wasn't also followed too, checking up its sales of $10 million. That amount is again too high, checking its sales. So why did Facebook make such an acquisition? The first reason was that WhatsApp was having 400 million users, and those 400 million users were potential new customers for the other products of Facebook too, and Facebook was forecasting a revenue out of the new customer base coming from there. And if we divide that amount with the total number of users, Facebook accepted to pay $55 for each new potential users. So the forecast of revenue out of each potential users should be higher than that amount in order to pay that amount for this. But Facebook didn't only pay that amount because of the user number of that of WhatsApp. It also paid that amount because WhatsApp reached to 400 million users with only 50 employees. So its fixed cost was also very low. So in some technology firms, as we have seen, there are lots of examples of it. Some other indicators can be followed according to the revenue expectation of the firm. And the main idea behind all business valuation methods is to compare the target enterprise value with the market capitalization, and the target enterprise value is found out by adding up the net debt with implied enterprise value. And as we said, and we have seen some examples, the credibility of shareholders like Bill Gates and executives of target business can affect the business valuation positively. The effectiveness of business strategy, having a good story, the customer base of target business, as we have seen in WhatsApp example, can be a good story. Also, there are some examples for that, like Chinese telecommunications sector, the alternative investments, the price of the alternative investments, the regulations, the quotas and fluctuations in demand side are all some possible exceptions in business valuation. And here our webinar is, if you don't have any questions, finished now.